Welcome back to Mastering MHA MBA. This is part 3 of 4 in our series on Chapter 7. In parts 1 and 2, we covered how firms set prices and manage costs. Quick recap of where we are. Pricing is shaped by customers, competitors, and costs. Target costing works backward from market price. Most costs are locked in at design, so early decisions matter most. Cost plus pricing ties markup to a target rate of return. Now we ask the next question. Which customers are actually profitable? In part 3 of 4, we shift to the customer side, why some customers are far more profitable than others, and what managers can do about it. This video is adapted from Datar and Rajan, Managerial Accounting, Pearson Education. Part 3 of 4 covers one objective, why revenues and costs differ across customers, and what managers can do about it. Let us dive in. Not all customers are created equal. Some pay full rates and need little support. Others demand discounts, require extra coordination, and generate hidden costs. Customer profitability analysis is the reporting and assessment of revenues earned from customers and the costs incurred to earn those revenues. Done well, it tells you who actually creates value for your firm. There are two sides to this analysis: the revenue side, the cost side. Customer revenues differ for two main reasons. First, customers buy different quantities. Second, they receive different price discounts. Price discounts are the quiet killer of profitability. A 10% discount to a big customer can look harmless, but stacked across many customers, discounts can wipe out the profit a salesperson thought they were earning. Tracking discounts by customer tells you who is really paying list price and who is not. Customer costs differ because customers place different demands on resources. Some customers place large, steady orders. Others place many small, rushed orders that need custom packaging and special handling. Same revenue on paper, very different cost to serve. This is where activity-based costing earns its keep. ABC traces the real cost of serving each customer. To make sense of those costs, we group them into a hierarchy. The customer cost hierarchy has 5 levels. Level 1 is customer output unit level costs. These are costs of activities to sell each unit to a customer. Level 2 is customer batch level costs. Think sales orders and shipments. These costs scale with the number of batches, not units. Level 3 is customer sustaining costs. These include customer visits and dedicated support. They support a specific customer regardless of units or batches. Level 4 is distribution channel costs. Think the cost of running a wholesale channel or a retail channel. Level 5 is corporate or division sustaining costs. These are the overhead that keeps the whole company running. Matching each cost to the right driver gives a true cost to serve. Using a simple average hides the real picture. Once you have revenues and costs by customer, you can rank customers by operating income. Plot them from most profitable to least profitable on the horizontal axis. Plot cumulative profit on the vertical axis. You get the whale curve. In most companies, the curve looks the same. A small group of customers generates most of the profit. A middle group breaks even. A bottom group actually destroys value. Cumulative profit rises steeply, levels off, and then often falls. Look at Exhibit 7-8 in the textbook. It shows Astel Computer's wholesale channel. Customers B and A produce the highest profits. Customers G, H, and I lose money for the firm. This pattern is the rule, not the exception. The textbook recommends a 5-step decision process. Step 1 is to identify the problem and the uncertainties. Step 2 is to obtain information. Step 3 is to make predictions about the future. Step 4 is to make decisions by choosing among alternatives. Step 5 is to implement, evaluate performance, and learn. The actions themselves usually fall into a few buckets. Expand relationships with profitable customers. Change the behavior of unprofitable customers through pricing, service terms, or minimum order sizes. Drop customers when the relationship cannot be fixed. A great example is the AT&T iPhone case. When the iPhone launched, heavy app use drove up data network costs. A small group of customers consumed a large share of bandwidth. AT&T responded by changing its data pricing structure. That is customer profitability analysis driving company strategy. Quick recap of part 3 of 4. Customer revenues vary by both quantity purchased and price discounts given. Customer costs vary by the demands different customers place on resources. Activity-based costing combined with the customer cost hierarchy reveals true cost to serve. The whale curve shows where profit really comes from and where it leaks away. In part 4 of 4, we close out chapter 7 with the long view and the legal view. We cover life cycle budgeting and costing, then price discrimination, peak load pricing, and the antitrust rules every manager has to follow. This video is adapted from Datar and Rajan, Managerial Accounting, Pearson Education. All rights belong to the original authors and publisher. Thanks for watching. Please like, share, and subscribe to Mastering MHA MBA for more graduate level accounting content.